Hello, and you're welcome to Global Business Insights after a short break, where from a global perspective we discuss insights, ideas, and answers to questions in the fascinating places where finance and life meet. The US Department of Justice has made recommendations for Google's search engine business practices, including a possible breakup of the tech giant as an antitrust remedy. This was after a US judge in August ruled that Google holds a monopoly in the search market. The court found that Google violated Section 2 of the Sherman Act, which outlaws monopolies. Kent Walker, that's Google's president of global affairs, said the company will appeal the ruling. As expected, New Zealand's central bank today slashed its benchmark interest rate by 50 basis points to 4.75% after its monetary policy meeting, marking a second straight cut to its benchmark interest rate. The Reserve Bank of India kept its key interest rate unchanged today as widely expected, but opening the door for rate cuts as early as December. We are starting the final quarter of the year with a mixed outlook from a market perspective, somewhat typical of the pattern all through the year, with geopolitics remaining the elephant in the room. Recovery in China could also be the dark horse. China, the world's second biggest economy after a spate of interest rate cuts and promises of more stimulus, was set to see the economy looking up, but details seem to fall short. While in the US, analysts are still nervously awaiting the October surprise before the November 6 elections, or is the surprise the fact that there may be none in a very tight race to occupy the White House? The Reuters Tankan, which closely tracks the Bank of Japan's quarterly business survey, showed the sentiment index for manufacturers was at +7 in October, up from September's +4. Japanese manufacturers turned more confident about business conditions in October, but still wary about the implications of the pace of China's economic recovery. US Wall Street's benchmarks finished up yesterday, recovering some of the previous session losses due to escalating Middle East tensions and a re-evaluation of US rate expectations. Investors are buying back into technology stocks and focusing on the upcoming inflation data and start of third quarter earnings season. The Q3 2024 earnings season gets underway, launched as usual by the earnings reports from the big banks later in the week. On Thursday, the September US CPI data, that's inflation, will be released. Last week in the US, a strong jobs report implied the Fed was in a better position to pull off a soft landing, confirming robust economic health. But on Monday, rising bond yields caused traders to reduce expectations on dovishness of rate cuts, giving up hope of another half-point cut in November and even possibly a pause. Crude prices are up over 10% in the last month, creating inflation worries for the Federal Reserve. Also last week, US port workers reached a tentative deal, including a 62% wage hike over 6 years, ending a 3-day strike that shut down shipping on the US East Coast and Gulf Coast. In another development, Boeing yesterday said it had withdrawn its pay offer to around 33,000 US factory workers, and no further negotiations were planned with their union representatives as a financially damaging strike nears its fourth week. We will discuss some of the labor issues set to resurface as we draw the curtains on 2024. In Africa, there is more evidence of economic progress from major economies, South Africa and Nigeria, as macroeconomics trend positively, but no obvious game changer in sight to avert tepid growth for 2024. Nigeria is moving more boldly to deregulate its downstream oil as it expanded tax incentives to give a much needed boost to the oil and gas sector. The issues in the Nigerian oil sector are structural, though stopping the bleeding as we see happening will help. Also in Nigeria, amid challenging demand conditions in an inflationary environment, the Stanbic IBTC Bank Nigeria PMI was little changed at 49.8 in September, compared to August's 49.9. According to the report, a higher crude oil production relative to the same period last year is likely to compensate for a lackluster non-oil sector's performance, thereby pushing real GDP growth to 3.1% year-on-year in Q3 2024. Capital importation into Nigeria from data released yesterday declined by 22.85% quarter-on-quarter to $2.6 billion in Q2, that's 2024, down from 3.37 billion in the first quarter of 2024. First, we look at crude oil prices expected to see increased volatility in Q4, as many factors could upend projections. Traders still uncertain on how the Israel-Iran situation will develop, as major supply disruptions have not materialized. If no major supply disruptions emerge and no large-scale strikes on Iranian oil infrastructure happens, WTI and Brent could slip further, with Brent going under $75 per barrel. Other factors to watch in Q4 include how much Libyan supply come back online, and of course OPEC production discipline and what happens with Chinese demand. Also weighing on prices, crude oil inventories in the US rose by 10.9 million barrels for the week ending October 4, according to the American Petroleum Institute. Analysts expected a build of 1.95 million barrels. Other market-moving news include UK oil major BP is set to abandon its 2030 target of cutting oil and gas output by 40% under new CEO Murray Auchincloss, as they look to new upstream opportunities in Iraq and Kuwait. Shell has won a major bid for the shallow water Block U in Trinidad and Tobago, beating BP and EOG Resources for the presumably gas-rich acreage. Like I had said, Trump's plan to reduce energy prices by 50% will have to contend with market forces, as investments in more expensive to produce US shale is likely to be held back by weaker economics. OPEC and Arab producers have the advantage of lower cost of production. On prices, yesterday benchmark Brent crude fell 5.4% to $76.56 a barrel, after rising by 10% in the 4 trading days following Iran's missile strike on Israel. That was on October 1. Today, slightly higher in early morning trade at over $77 a barrel for the Brent standard. And in the US, the deal with the union ends the biggest work stoppage of its kind in nearly half a century, which blocked unloading of container ships from Maine to Texas and threatened major shortages, triggering a backlog of anchored ships outside major ports. Meanwhile, the striking union of Boeing's West Coast factory workers is seeking a 40% pay rise over 4 years and restoration of a pension-related benefit that was taken away in the contract a decade ago. There are 2 broad issues at play here. First is the recent unanticipated inflation, which has eroded earning power, driving a call for some compensation for much higher erosion of earnings unforeseen in previous negotiations. Second, for port workers, is the issue of automation, artificial intelligence, and improved productivity, which certainly will threaten jobs. The present trend is that of high staff mobility, as companies intensify people care to hold on to talent that they must have. My sense is that the macroeconomic instability has put unions at a disadvantage with their fixed long-term contracts. Workers are increasingly better off by reskilling and entering more flexible, more dynamic non-union wages environments. Automation is a more complex, inevitable development. Workers need to be carried along, making them more aware and knowledgeable on the changes that are coming. Re-education and retooling should be more proactively addressed, and unions can demand for more comprehensive approaches to reconfiguring the workforce, rearming workers with new competencies as much as possible. Then, of course, the trust deficit post-COVID cannot be allowed to expand. People must be carried along on the change trajectory ahead, with more transparency on which jobs will be affected and the options to minimize the pain of impacted workers. Organizations should not underestimate workforce adjustment costs as they move aggressively with digitization and plot major productivity overhaul leveraging AI. Already, AI assimilation implies more upfront costs, tempting companies to underestimate the added costs for people-related investments. Capital importation into Nigeria declined by 22.85% quarter-on-quarter to $2.6 billion in the second quarter of 2024, down from $3.37 billion in the first quarter. $2.6 billion in the second quarter is, however, a robust increase of 152.81% year-on-year compared to $1.03 billion in Q2 2023. A detailed breakdown revealed that portfolio investment inflows was $1.4 billion, accounting for 54% of inflows, followed by other investments that came to $1.17 billion, accounting for 44.9% of inflows. Foreign direct investment, which has the strongest correlation with economic growth, showed a paltry $29.83 million inflow when you look at capital importation in Q2 2024. This trend reflects the challenge for Nigeria in attracting needed long-term capital to drive sustainable economic growth and job creation. President Tinubu, in his last Independence Day speech, had said the economy is undergoing the necessary reforms, and according to him, foreign direct investments worth more than $30 billion came in the last year. The data we suspect the president is referring to must refer to commitments as opposed to actual inflows. The FDI data of yesterday points to a significantly lower figure and shows little changed in terms of FDI. In contrast, South Africa recorded FDI inflows of 24.4 billion rand, that's $1.34 billion in the first quarter of 2024, up from a revised 2.5 billion rand in the previous quarter, and easily more than 40 times higher than FDI importation into Nigeria. To put it plainly, Nigeria has to attract significantly higher FDI, improving attractiveness factors like infrastructure, macroeconomic stability, and security, noting that portfolio investments are more volatile. The world's largest second miner, RioTinto, said today that it will acquire U.S. lithium producer Arcadium for $6.7 billion. The deal would be an all-cash transaction for $5.85 per share, also a premium of 90% to Arcadium's October 4 closing price of $3.08 per share. Asia Pacific markets rebounded today after a decline in the previous session and as Wall Street rallied overnight. Investors are focused on digesting today's policy decisions from the Reserve Bank of New Zealand and the Reserve Bank of India. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Again, thank you so very much for watching. Bye-bye.